Palantir won new government contracts in late March. The stock dropped. That is not a normal market reaction. Contract wins are supposed to be catalysts. They are supposed to confirm the thesis. Instead, the market looked at the news and sold. The reflex answer is macro pressure. Tech was broadly weak, tariff uncertainty was elevated, Powell made comments that rattled rate-sensitive growth names. All of that is true, but it doesn't fully explain why Palantir specifically absorbed the damage more than peers. The market is trying to tell you something about how it has recategorized this stock. Here is where the consensus view lives right now. Palantir is positioned as the pure-play artificial intelligence name for defense and enterprise. It has Gotham on the government side, Foundry and AIP on the commercial side. It has been winning contracts. Commercial revenue has been growing at rates that impressed even skeptical analysts. The narrative is clean. AI spending is accelerating, government needs it, Palantir built the infrastructure first, the moat is real. That narrative is not wrong, but it is priced. And what the market is debating now is whether the price already assumed a future that is still 2 to 3 years away. The valuation problem is structural, not cyclical. One analyst framed it plainly. Palantir has one problem, and that problem is the multiple. Even those who are buying the stock are buying it despite the valuation, not because of it. That is a meaningful distinction. It means the bull case depends on execution at a pace that leaves zero room for deceleration. Now here is the thing most people are walking past. DOGE, the Federal Efficiency Initiative, is being read as a tailwind for Palantir. The logic is intuitive. If the government is cutting headcount and demanding more output per dollar, AI software becomes essential infrastructure. Palantir's platforms theoretically do exactly that. So DOGE scrutiny on federal IT spending should in theory accelerate the replacement cycle in Palantir's favor. But that logic has a gap. DOGE is not selectively cutting inefficient legacy vendors and replacing them with Palantir. DOGE is cutting broadly. Budget freezes hit new contract obligations before they hit existing ones. If an agency is under spending review, it is less likely to sign a new multi-year platform deal, even with the vendor that would theoretically save it money in year 3. The short-term spending constraint and the long-term efficiency argument are pointing in opposite directions on the same timeline. This is why the contract win in late March produced a shrug. Investors know Palantir can win contracts. The question is whether the pace of contract wins can accelerate fast enough to justify a valuation that is pricing in years of compounding growth in an environment where the government's near-term buying behavior is genuinely uncertain.
Stanley Druckenmiller notably increased his holdings in 2 leading AI stocks for a second consecutive quarter, and they were not Palantir. They were not NVIDIA either. That tells you something about where sophisticated capital is looking for AI exposure right now. It is not running away from AI. It is being more selective about which AI names to hold at current prices. The NVIDIA comparison is instructive here. When analysts line up NVIDIA versus Palantir as competing ways to own AI in 2026, the frame is hardware versus software. NVIDIA sells the picks and shovels. Palantir sells the map and the strategy for the miners. Both arguments have structural merit, but NVIDIA's revenue has a more direct and measurable link to AI infrastructure build-out. Palantir's revenue depends on enterprise and government organizations actually deploying AI at scale, not just buying access to it. Deployment cycles are slower. Budget approvals are slower. The software monetization story is real, but it runs on a longer clock than the hardware story. Michael Burry closed out the quarter by saying that shorts are not forever. He was commenting on the rough quarter that Palantir and NVIDIA both had. The statement cuts both ways. It means the pressure is not permanent, but it also implies the current position is one where patience is required, not one where the setup has already resolved. So where does this actually sit? The downside path is not complicated. If federal IT spending faces a freeze longer than 1 or 2 quarters, Palantir's government revenue growth stalls. If commercial AI adoption slows because enterprise budgets tighten in response to tariff-driven uncertainty, the commercial growth story decelerates. A stock priced for compounding growth at the current multiple does not need a catastrophe. It just needs a quarter where the numbers come in slightly below what the multiple assumed. That alone can compress the stock meaningfully. The recovery path runs through the same DOGE dynamic, but on a longer horizon. If the efficiency pressure on government agencies eventually forces a consolidation onto fewer, more powerful AI platforms, and Palantir has deep enough existing relationships to be that platform, then the near-term contract uncertainty becomes a setup for a larger, stickier revenue base in 2027 and beyond. The Polymarket partnership on prediction market integrity is a small signal of how the commercial use cases are expanding in unexpected directions. That kind of optionality is real, even if it is not in the near-term model. The evidence leans toward continued pressure in the short term, with the fundamental story remaining intact. The condition that matters is whether Palantir can hold its government relationships through the DOGE uncertainty without losing key contracts to the budget acts, not as a question of capability, but as a question of timing. A company can be right and still be early, and early at this valuation is expensive.